Good morning, everyone. Thank you for joining the Market Chameleon pre-market webinar. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. This show and webinar, as all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, good morning, Dimitri.
Good morning, Will. How are you?
Good.
Good morning, everyone. Let me share my screen here. And today, what we'll do is cover how to, can you see my screen, Will?
Yep, looks good.
What we'll do today is cover a bearish call spread idea in SPY. So if you're looking at a market that appears to be downward trending, and you're thinking about either hedging some of your portfolio risk, or even have a bearish outlook, how can you hedge or profit from a downward market? And there are different types of strategies. In this situation, we'll look at a bearish call spread. Now, to look for it, we're going to use SPY as the security to hedge against the market. SPY is the S&P 500 ETF. So let's first go to the SPY, type it into the search box on top. We land on this summary page, and on the left-hand side, we have this menu under options. Let's click on trade ideas. And then we will come to this page that scans different trading strategies, comes up with ideas based on preset conditions. Okay, so I'm going to close this menu, and we have these trade idea cards. You also have this select strategy where you could drop it down and look for different types of strategies. The top three are displayed based on theoretical edge. The first one's a bear call spread. Then you got a bull put spread. You have a credit iron condor. We're going to look at this bear call spread today. And this trade idea card gives us some information about this particular strategy. And then we could go into this strategy and dig deeper to get more analysis and insights into it. So the strategy here, the bear call spread, it involves down here, you could see here, selling the March 20th expiration on the 567 strike, and buying the March 20th 572 strike. So within this trade card, what we see is that's a bear call spread. If we come up here, we see that this is an upside call spread. You could see that both strikes are above the current stock price. The cost of it is a credit of $1.77. So you're basically receiving a credit for selling this call spread. That would be your potential profit. Right? That's if both options expire worthless, you stand to make $1.77. This spread, why did we filter it out? Well, we have a benchmark. In the benchmark, we look at historical price movements of SPY, and based on that, we came up with a average end value of $1.21. Okay, so from a historical perspective, based how the stock moves, the average value is $1.21. So this here, since we're getting a credit we're getting a credit, we're selling it above that historical benchmark by 17%, which in theoretical terms, we're getting, a better price than that average, more than the historical average price. In addition, here we have a historical win rate, and this gives us a little bit more information based on the historical stock distribution, based on how the stock moved. 74% of the historical outcomes in the similar situation, if we looked at the same amount of trading days to go with strikes same distance away, and if we applied this credit of $1.77, let's say we assume that we did it a similar situation, it's saying that the outcomes would have been profitable 74% of the time. In other words, at the expiration or by the end of those trading days, 74% of the time, the stock, the way it moved, would have resulted that this spread you would have been able to close out below $1.77. So if you sell something, at one price, if you could buy below, if you could close out below that price, it would result in a profit. Okay, so sometimes it could have been, it could have been completely zero, and it would have resulted in keeping the entire credit. But sometimes you may have to close out of it at a higher price, or sometimes at a lower price as well. So let's say we're interested in this particular spread and we want to look deeper into it. If we click on this arrow here, options chain, click on that. This will take us to the option chain, and it'll populate those legs for us. So this way it is, sorry, well, do you actually, I'm not sure if that comes through. Let me just take a look. Well, can you?
Yeah,
can
let me
hear
take
me?
a look.
Let me see if that. I don't think that
I'm
comes
showing the
through.
trade cards still.
Okay, yeah. So on this version, I don't think it'll show the next page because it popped into the next page. Let me see how to do it. So when you do that, what it will do is come to the options chain, like here. We'll go to the March 20th expiration. Okay, and I'm doing this manually, but this does it for us, and it will select the 567 call, selling that, and buying the 572 call over here, 294. Okay, so let's run that, and this is the spread. So we could see here, selling the March 20th 567 call. This is where the price of the bid closed, 471. Buying the 572 call. This is where the ask price closed, 294. That comes out to $1.77 credit. So here we have the historical return distribution. Based on that, you can see that there's $1.18 average end value. Let me close this menu to expand it. The difference is 59 cents. Difference between the credit and the theoretical value, and there's a historical win rate 75%. Now, that's one evaluation. Let's take a look at another one, because there's no one way to run that theoretical value. We could look at it from different perspectives to try to put a value on this particular strategy using data. Another way we could look at it is if we found similar situations historically and we looked at the options markets. So not how the stock behaved, but if we looked at the options markets, the implied volatilities, and we took an observation with, where the options still had the same amount of days to expiration, 6 trading days, the distance of the strikes were similar. If we took the implied volatilities, right, and from history and looked at the observations, what was the average value of this particular spread? So similarly, how we looked at, if you're looking at implied volatility levels, we could look at implied volatility levels by option contract, by the makeup of that option. So here we see that the average value of this spread was 96 cents. So here we're way above that, $1.77. We could see the median value, half the observations were below this amount, half above, 92 cents. And the range as low as 33 cents to 216. So we're closer to the higher end of the historical range than the lower, right? And if I had to, kind of paint a comparison of what we're doing here, is if you were looking at implied volatility, well, you could look at implied volatility and say we're in the low end or high end of the implied volatility range. Well, we're doing similarly to that using this spread, right? So we're just focusing on this spread alone. So here we see we're on the higher end. Okay. Another way we could evaluate it is say, okay, the $1.77 bid, this is what the current bid is on this spread. Well, based on the markets, where is the midpoint, right? If we're looking to get an execution as a trader, you're always trying to get the best possible price. That's that's just duty, right, of a trader. That's something that you have to work on being efficient. Well, how much room is there to improve on that price? Like, can I get, you want to sell it, if you want to be able to sell it at the highest possible price. Well, here is the market. It's a $1.77 bid, but the offer is $1.90. So it's pretty far away, right? It's not a penny wide. The offer price is here like 13 cents away. So seeing that, there's a potential for price improvement. Maybe once $1.78, $1.79, $1.80. And where's the midpoint? So the midpoint of it, which we kind of use as the fair value mark to market. Since there's a $1.77 bid and a $1.90 offer, we know that the fair value of that spread is somewhere in between there, right? Between $1.77 and $1.90, where it could trade. So the midpoint is 184. So let's say even at 184, right? Even at 184, you still have a 7-cent potential improvement there. Something to keep in mind, by midpoint, maybe even get higher than midpoint. If there's a demand to buy these spreads, you might be able to get 185, 186. It's important to look at that and understand that in your trade, and think of it as in percentage terms. What is 7 cents for $1.84? it adds up. You're talking about a trade, one single trade, 4, 5, 6%. If you could think of it, if you could just improve your trade execution by 5% each time, 5%. If you could improve that trade execution, that will add up to an extraordinary amount over time. That could be the difference between success and failure. It's important to understand that. So what we're doing here is initially we're evaluating the spread at the lowest price, right, that you could get executed. The worst price you could get an immediate execution based on the displayed bid and offer. Because if the bid is displayed at $1.77, at that moment you could get that price. So that's where we start out the evaluation. That's where this trade card starts to say, okay, if we use that price alone, how does it look? But if you get a better price, let's say $1.84, all these improve, right? That your edge improves, your win rate probably improves, this improves. Basically, your potential reward improves, right? Now you stand to make $1.84 instead of $1.77, and your potential risk gets reduced too, because now you've gotten more, right? Since you got more up front, that means that whatever you're risking, right, is reduced in this spread. So it's very important as a trader to pay attention to that, to always try to figure out strategies and ways to improve the quality of your executions. If you're inefficient in that, just like inefficient in other things, if you're an inefficient trader, it will show up in your trading success. Okay, so please pay attention to that. I think a lot of people somehow don't get that and just start doing things not efficiently, and then they're like perplexed why isn't things working out for me. These are the risk sensitivities of this spread, and this takes the spread and then puts it into the different risk sensitivities of this strategy. So the strategy has a negative delta. Negative delta means it will do better. It has a short bias, right? The bias is to the downside. Okay, meaning that if the stock moves down, this will gain in value. For a dollar move, it'll gain in value 10 cents. Up, if it moves up a dollar, we'll lose 10 cents. Okay, has a short gamma, short vega, long theta, short rho. I'm not going to get too much into it, but why do we break it down to those sensitivities? Because that's another way you manage your risk, right? How do you manage risk? Part of trading is managing risk. It's not just doing trades, it's managing your risk. But to manage your risk, you have to know what your risk is, right? What is my risk? Then when you know your risks, then you can figure out ways to manage it, right? So that's what the options pricing model does, is allows us to put in our positions, the inputs, the assumptions, and then observe our risk, so then we could manage it better. All right, so think of it this way: if you have a portfolio of rental properties and you're managing the risks of those rental properties, right? There's all kinds of risks involved there that you would want to know, so you could manage it better, more effectively, more with mitigating your potential losses. So you want to know, well, how old are your roofs? Is there risks that you need to repair those? When are your leases coming up? Like if 90% of your leases are coming up all in the next month, well, you got some risks there, that you have to start thinking about. If you have mortgages that are going to reset, variable mortgages that are going to reset, well, you got risks of that. So managing your risks becomes, one of the major factors in your trading. So, and it's important, to know your risks, to be able to observe them, and that allows you to manage and do other trades to mitigate your risks. Okay. The next one is, this just gives us quickly a price chart of this spread, and we could see what the price based on the bids and offers, because the bids and offers are changing as the market is moving, and that allows us to know what the markets were valuing the spread at. And based on those bids and offers, we could see that it was as high as 221, the midpoint, as low as $1.49, median price $1.88, average price $1.87. So quickly, visually, we see that this spread moves around, right? That even in the one day that we charted here, we could go back further, it moves around. It's not like something that sits at one price or moves up or down a penny. It has some volatility. I mean, look at the range, from the high low, 221 to $1.49. It's a lot of volatility, right? It's big. Percentage wise, it's a big difference in that, how the spread moves. And we could see from the start of day, started out at 218 to the end of day, it finished $1.84, okay, down 34 cents. Another factor that plays into it is that's the midpoint, but the midpoint doesn't always tell us the whole story, because the midpoint between the bid and offer doesn't tell you how wide the markets were. So the markets could be, you could have a market that's 2 cents wide, you could have a market that's 10 cents wide, but the midpoint will be the same, right? So how wide is the bid and offer away from the midpoint? So that's the spread. That's what we call the bid-ask spread. So we could see here the bid-ask spread was as wide as 23 cents at the high. It got as narrow as 6 cents. The median is 10 cents and average is 10 cents. So it's typically 10 cents wide, okay? But it's gotten as narrow as 6 cents, as wide as 23 cents. It started out in the morning 15 cents wide, ended up 13 cents wide, okay? So narrowed down. That's important too, because when we're talking about quality of execution, well, you're trying to get an execution somewhere in between that spread, right? Somewhere between the bid and an offer, so how wide is it? How much room is there for price improvement? And if you had to exit it, because you have a risk there that I may need to exit this at some point, right? If you don't intend, to just hold it till expiration, and maybe you do intend to exit it, it could be, something you want to do for 1 day or 2 days before the options expire. Well, what is my execution risk if I need an immediate execution to exit this? That's an important evaluation. In your total analysis, it's an important evaluation. Then here, quickly, we have a payout diagram, and this shows at expiration what your potential reward and risk is, right? So this shows us, potential reward, $1.77. If we sold it for $1.77, and both options expire worthless above this, below this strike. That's our potential reward. Here's our break even, and our potential risk is $323 if the stock goes, above that high strike. All right. So really quickly, you could see here the current stock price is $559.39. The break even is $568.77. So you could see here that the stock could rise. This is bearish. It could rise from here, and you're still okay. So it's not like shorting the stock right at this moment at expiration. You lose. It could rise. So by expiration, you still have a 1.7% upside cushion. It could go up from here 1.7% from now to expiration, and it will hit your break even. Okay, so anywhere below that, it would be profitable. So your max gain is below $567 because that's where you sold that first leg, 567. Okay, which is, you could see here, it's above the current stock price. And what that means is that even for your max gain, the stock could rise as much as 1.4. Obviously, if it goes down or stays here, you're good. But even if it goes up 1.4%, it hits that 567, you'll still hit your max gain. Right? As long as both those options expire worthless, you hit your max gain. Which means, like, even if the stock goes from 559 to 560, 561, 562, both those options will still expire worthless. So then what is our potential reward, right? We know, what can we stand to make in the next, whatever, we have 8 calendar days. What's our potential reward? Well, our potential reward is based on how much we have at risk. So it's a $5 spread. So we're risking $3.23. If we sold it for $1.77, we have to buy it back for $5. We lost $3.23. So if we risk $3.23 and our potential gain is $1.77, that means based on what we have at risk, we have a potential to make a 54.8% return. Okay. So that's your potential return for what you're putting, risking on this strategy. So now, we have a good, picture of this trade, and we could go in there and analyze it further. But this quickly, once you get used to it, you could scan with your eyes, and you could see, pretty quickly an evaluation of the spread from the perspective of, historical pricing, quality, potential price improvement for quality of execution, your risk sensitivities, the volatility of this spread throughout the day, and your potential payoff versus your risk. All right, well, I'm going to stop right there. I think we, covered pretty much, everything on this page.
That was great, D. Super helpful. Everyone is very thankful for this morning's webinar. Everyone who joined, thank you very much. Remember to like and follow us on YouTube, Facebook, Instagram. We are everywhere now. Thanks so much, D.
Thanks, everyone. Have a great trading day, and we hope to see you tomorrow.
Trade in peace, chameleons. Everyone have a great day. Bye-bye.